Luiz Pereira da Silva es director general adjunto del Banco de Pagos Internacionales, BIS, desde el 1 de octubre de 2015. Antes de unirse al BIS, el señor Pereira da Silva, de nacionalidad brasileña, se había desempeñado como vicepresidente del Banco Central de Brasil desde el año 2010. Y antes de eso ocupó varias posiciones en el Banco Mundial en Washington, D.C., Tokio y África Meridional. También ocupó el cargo de economista jefe en el Ministerio de Presupuesto y Planificación de Brasil y de viceministro de Finanzas de Brasil a cargo de asuntos internacionales. Luis, the floor is yours.
Entonces, muy buenos días para ustedes. Es un gran honor ser invitado para hacer esta presentación al Banco Central de la República Argentina. Yo soy Luiz Pereira da Silva, el director general adjunto del Banco de Compensaciones Internacionales. And I'm going to switch to English now to do a presentation on macrofinancial stability policy frameworks for particularly middle-income countries or emerging market economies, the past, the present, and their future. The outline of this presentation is that, of course, starting with the first priority today, to fight inflation, but I believe that still these frameworks and this agenda have great value. And the reason is that we need to manage the effects of large capital flows in all global financial conditions, whether they are good or they are bad. Remember, we had, for example, the post-global financial crisis 2008 financial exuberance period, but we had also the taper tantrum of 2013. And today, in 2022, with the strengthening of the US dollar and the Fed tightening, I think it's worth discussing how these frameworks can bring some value for central banks. Now, the second point is that these frameworks evolved. Remember, we had simple ways to manage aggregate demand with just monetary and financial policies, combination of both, but then we evolved towards inflation targeting regimes with flexible IT and floating exchange rates. Now, these frameworks got into more complex challenges with global financial integration because of the dominant role of the US dollar, large debts in foreign currency, both on the public and the private sector, and also with a lax pre-GFC regulatory framework with a lot of imperfect information about credit risks, and of course, the spillovers of monetary policy of advanced economies into emerging markets. Now, because of these challenges, actually, what happened, and this is the fourth point, practice went ahead of the theory. So we had, in fact, and this is something that I will discuss, frameworks that not only had monetary and fiscal policy, but operated with a larger toolkit, with macroprudential policies, with FX interventions, with capital flow management. And these frameworks were tested by these episodes that I just alluded to. So perhaps the challenge for research departments is to lay directions to catch up between the practice and the theory with new models that combine monetary policy with the other various policies instruments. But then I believe, and this is a case that I will make in the presentation, they explicitly need to represent fully the banking sector to capture the transmission of these policies in a meaningful way. And then finally, I will allude to extensions for research of these frameworks on the green economy and also on inequality, but that poses issues, as you well know, of mandate. So starting with the evolution of these frameworks for central banks, I think they were basically the result of lessons learned and consequences of crisis. Just remember the beginning of the story, let's say framework 1.0. These were the 80s and the 90s. Basically, countries were facing standard current account balance of payment crisis. Of course, they resulted from excessively expansionist policies. And there the response was relatively simple, applying basically the separation principle of Timbergen, you treated domestic stabilization issues with basically a combination of monetary policy and fiscal policies. And of course, they had their effect on aggregate demand. And then external stabilization, you had fixed exchange rate regimes, sometimes pegs, and then they had to adjust to rebalance the external sector. Then, of course, later on, frameworks evolved to 2.0 with capital account crisis. Remember in Asia in the late 90s, for example. And there you had the combination of a response that consisted in basically evolving towards flexible IT regimes with a specific target, and to build credibility by achieving essentially the goal set by the target. And then, of course, you use not anymore regimes on the exchange rate that were more rigid, but you had floating exchange rates as a shock absorber. And you added to that stronger institutions. You had rules that were based on essentially limits to public debt. Sometimes they were enshrined in laws. You had the predictable reaction functions for the central bank, for example, Taylor rules or something similar. And you focused also on a number of structural reforms to get your economy more resilient. The focus was to integrate more towards trade, to bring efficiency in public spending, and to put public spending in line with long-term trends in demographics. So the new complication that appeared in the 90s, in the late 90s, was of course brought by the greater financial integration in the world, and essentially the new role of external conditions that definitely affected domestic macroeconomic conditions. Of course, greater financial integration on the one hand is very good. I mean, you can benefit from foreign direct investment and productivity, but then you have also to consider that you might run into risks of having an open capital account if you don't have the adequate regulation in terms of your banking sector, if you don't have the right data, and if you don't have the monitoring tools that are necessary for an open capital account. And you started having, in effect, in these years, 90s, 2000s, global factors affecting definitely domestic financial factors. In a sense, it was as if you were connected to the global financial system and you had a financial amplification from this integration. And what I'm sure everybody observed is a succession of credit booms and busts that became more frequent, more volatile exchange rate, and more risks to financial stability. Now, of course, there were responses to that, and despite the famous original sin, you had the rise of local bond markets, but they were also populated by foreign investors. So in a sense, the original scene where you had no FX debt issue by yourself became also a search for yield and a risk-taking channel of exchange rate by foreigners investing in domestic markets that affected financial stability locally. And therefore, the result of that was, in fact, that you brought to yourself more FX volatility that impacted domestic financial conditions. Of course, this had an effect on valuations of your assets, collateral effects, and you had with that a potential risk of amplification of local financial cycles by these large inflows and outflows of capital. So you ended up with actually episodes that can be labeled sudden stops, of course, but also sudden floods of large capital flows. And you had on top of that the spillovers of monetary policy of advanced economies. Remember the exuberance during the post-GFC period. So in some sense, the domestic independence of the central bank was true and sometimes even enshrined in law, but it was not necessarily independent from the monetary policy of major advanced economy. So what was missing in this way of looking at the frameworks that we had, even more sophisticated one, was an explicit representation of very important agents in the economy that were banks. This is the missing point that I want to highlight that may help us to account for the transmission of foreign flows, capital flows into the domestic conditions. Now, to some extent, the central banks, in fact, had a practice that went well ahead of theory, because they adapted pragmatically to these new global financial conditions. In fact, many central banks in emerging economies moved to a sort of framework 3.0. Basically using a combination of instruments on top of the monetary policy rate to achieve price and financial stability. Because to some extent, monetary policy, the policy rate, could be in some cases a bit too blunt to correct imbalances, and could, if you use it in a procyclical way, trigger a search for yield and exacerbate actually capital inflows. So the issue became how to exactly calibrate monetary policy in EMEs that were receiving a lot of capital flows to lean against the financial cycle with a sort of in an optimal way. And of course, the response was to use other instruments as complements and not of course as substitute to monetary policy to contribute to financial stability. So first, many central banks start using micro-prudential tools, and then very often they move to macro-prudential tools like capital and reserve requirements, dynamic provisioning, countercyclical capital buffers, debt-to-income limits, loan-to-value limits as well. And this is especially important when you have a dominant banking sector providing credit for your economy. And this is, of course, the usual case in most middle-income economies. Then, in order to also minimize the volatility of exchange rates, most central banks started using foreign exchange interventions. In practice, I would say we were moving towards a sort of managed floating. As a last resort, you used as well, many central banks used as well capital flow management, which sometimes is termed the capital controls, to moderate and lengthen FX flows maturity. Now, this is a debate that is complicated. We'll not get into that. It's usually a last resort measure, and it works much better when you are facing large inflows. It works much less when you are facing large outflows. So the last issue in this pragmatic adaptation to new global financial conditions was how to use fiscal policy. And there we know that in most, or if not in all emerging market economies, fiscal policies to be countercyclical is always a complex issue. And this is naturally due to the political economy of fiscal policy. But it's also due to the fact that when you have very large inflows, like you had in the post-GFC period, there is an appreciation of the exchange rate. And there is a sort of a feel-good feeling that actually strengthens the procyclicality of tax collection and sometimes affects the overall macroeconomic conditions and the financial cycle. To illustrate that with a table, for example, this is for Asia. We had a report of our member countries in Asia. You can see that these are, let's say, the countries in columns. You can see Hong Kong, India, Indonesia, Korea, Malaysia, China, Thailand, Singapore, right? And you see what types of instruments they were using for external stability. I tried to put some sort of dotted circles or to illustrate that, but I didn't manage to do a good job. But you can see that most of, if not all of these countries basically use the FX interventions and capital flow management for external stability. And for domestic financial stability, they use the macroprudential measures as well as the monetary policy rate. And for macro stability in general, which includes both financial and price stability, you can say that majority of countries use a combination of macro proofs with the domestic policy rate. Now, can we say that we have directions to make the analytical work, the theory, to catch up with the existing practice? I think we can. I mean, there are some reasonable progress in analytical work. The BIS itself has submitted a report to the G20 on macro financial stability frameworks, how they operate. We mentioned that also in our annual economic report 3 years ago. The policy implications is that what is important is the sequencing, the timing, the intensity, and the calibration of instrument. This is what might be the difference with a pure intervention using just monetary policy. Now what you have is actually, as I illustrated in the previous slide, a combination of monetary policy with macro proofs, FX interventions, capital flow management, and also fiscal policy. And if you want a sort of a good example of that, think of the post-global financial crisis period, where you have actually a capital flood into many emerging markets, very, very large inflows. I remember vividly this period because I was at the Central Bank of Brazil in this moment, and we had, as you may remember, very, very low interest rates. Zero lower bound was reached. You had quantitative easing. You have even forward guidance, sort of shaping expectations of very low interest rates for a long period of times. And of course, this obviously interacted with your domestic credit market. Even if you had to correct some excesses with monetary policy, actually, by making monetary policy more active, you could trigger a search for yield, and you can compound actually the exchange rate appreciations of the capital flows that you are trying to countervail. Now, also there is, I myself went into this type of research and analytical work with to catch up with the practice. And I think the idea here is that we need actually new modeling strategies. As I was saying, you need an explicit banking sector in the model to capture the transmission of risk into the loan rate of the economy, and also the exchange rate effects. And in a little book that we published 3 years ago, we labeled this type of regime integrated inflation targeting. How can we define that? Well, integrated inflation targeting for us is a flexible inflation targeting regime in which the central bank mandate includes explicitly a financial stability objective. So you had to do 3 things. You need to have a state contingent, depending, of course, on credit market conditions, augmented policy rate that reacts to some extent of what you should measure carefully as a excessive credit in your economy. And you react to that not only with the policy rate, but also with macroprudential policies and instruments in, of course, a contracyclical way. And this is, as you saw in the previous slide, this is exactly the practice of most central banks today. Now, the important point here is that you know that these two instruments, the policy rate and macro proofs, they have simultaneous effects. So if you want to reach an optimal level of intervention, of contracyclical interventions, these policies need to be calibrated jointly, because it's only when you calibrate jointly these two policies that you can assess their combined effect on stability. And then you use, of course, FX intervention only to smooth the volatility of the exchange rate, and never, of course, to set a specific level for the exchange rate. So you have a managed float regime as a sort of a buffer to what's happening to the FX market, and a sort of a first line of defense. Now, of course, this type of regime requires many things that are not necessary in place. First of all, there is a communication challenge, because you are making the policy regime aiming at price and financial stability, but with more instruments than just the policy rate. So you need the credibility in order to make sure that the market participants understands that you are not substituting one instrument for the other, that you are using both for financial and price stability. And if I may summarize the kind of the trick of this type of these modeling strategies, it's to integrate explicitly and in a detailed way the transmission channels that affect the loan rate in your economy. Basically, you know that the loan rate is the policy rate plus a risk premium plus the effects of the policy instruments that you put in place, basically the macro proofs that I was referring to. And the key in the modeling strategy is to precisely detail how these different policy instruments can be represented in the what I call the effect of policy instruments. And we're talking here about CFMs, capital requirements, FX interventions, and of course how they will interact with the risk premium of banks in the determination of the final loan rate. So in a sense, what you make explicit is a cost channel of monetary policy with integrated interactions. And for that, guys, there is an absolute need to have an explicit financial sector in the model. You need commercial banks, you need a central bank, of course, you need a regulator, you need households with, let's say, a collateral that participates in the valuation effects. And of course, you need firms for investments. So it is true that these models can be small. For example, if you think of a closed, small open economy model, but usually if you really want to have all this, they end up usually into a little bit more complex models. It can be the SGEs, but the SGEs are sometimes excessively complicated. The bottom line here is that you cannot save on some degree of complexity if you want to capture and you want to calibrate accurately the effect of each of these policies instruments that I mentioned. And here an illustration again with our colleagues in Asia, in terms of the type of modeling strategies that they use in central banks. And you can see that there is a sort of a combination of things. If the models serve to forecast inflation and output, basically the basic mandate of central banks, then usually you talk about very large scale DSGs. And if you want to assess financial stability, you go for relatively small, more empirical models, VARs, and so on and so forth. And you can see that if you look at the way these models operate, They usually do not assume the existence of financial frictions, and they do not really capture the way in which FX interventions and other macroprudential tools operate in your economy. So obviously there is more effort to be done in this area. So I just submit, and I just actually sent to you a draft. We are working on this in still a memo that will be published hopefully in the next few months. We try precisely to explain the interactions between, in a very pedagogical way, between monetary policy and these other policy instruments that I alluded to, the macroprudentials, the capital flow management, the FX interventions, and fiscal policies. In this sort of manual that we are building, it's a very pedagogical tool because it allows progressively for you to move from simple models to see how you calibrate combinations of instruments to increase the effectiveness of policy responses to capital flows. So this is basically where we stand. So we have a practice in place, but we are moving towards catching up in terms of the analytical work. So to finish this presentation, let me just mention a couple of extensions on frameworks that are being discussed, but of course then you immediately see that they pose an issue of what exactly should the mandate of central bank be extended to, and is it legitimate to extend the mandate to other areas? The first is what we called in a recently published book, inequality hysteresis. The observation here is that inequality matters for the transmission, for the effectiveness of monetary policy. We did some empirical work. We know that basically inequality has a structural long-term dimension, and there is a huge literature. What we try to explore is a bit more the cyclical dimension of inequality and the way in which inequality makes the transmission of monetary policy more difficult, because recessions tend to make inequality more persistent. And therefore, if you don't pay attention to that in your stabilization policy, well, you might sort of end up in sort of a situation of permanent levels of inequality that makes the transmission of monetary policy harder. Just think of the simple idea, the propensity to consume in a society where you have large groups of poor people and groups of more rich people is different than a propensity to consume and to save in more homogeneous society. So this is, as you know, a reflection that has led some central banks, including in advanced economies, to think of modeling strategies not with a unique representative agent, but with more heterogeneous agents. A second idea is the way in which you have all this transformation in the digital world, with a lot of financial innovations. And we know that financial innovation is very important. The BIS has been working very, very hard. And I suggest that if you are interested to look into the production of our innovation hub. But what we know as well is that financial innovation has implications for financial stability and also for financial inclusion. It can play a very positive role in making more easy access to credit by being capable of identifying better individual credit risk with, for example, big data and artificial intelligence. But it can also, to some extent, create financial exuberance. It can create a number of issues. We just saw in an advanced economy, the UK, for example, how some innovations, or at least some specific products, we saw the global financial crisis, can also be a destabilizing factor in advanced economies. And last but not the least, this is one thing that is very dear to my heart, is the idea that we have to think of the effects of climate change on risk. And we wrote also 2 years ago this little book, we call this Green Swan. And the idea is that it's different. You remember during the global financial crisis, we talked about black swans. Black swans are tail of distribution risks. So it happens very rarely, and you know, it can occur because of the sort of minimizing the risk, the tail risk of financial instruments and so on and so forth. A green swan is completely different. A green swan is certain to happen if we do nothing in terms of fighting global warming. Because this is what the best scientists are telling us. They're saying, look, the effects of human activity on climate is proven, and you have a number of risks that are appearing and that we are observing, physical risks, transition risks, that directly affect financial stability. So if in the central bank's mandate there is financial stability, then inevitably at some point in time you need to think on how climate-related risks will affect the financial stability of your system. Think of, for example, the losses that physical risk, storms, heat waves, and so on and so forth can cause to your economy. I mean, we've been seeing this for now the last 5-6 years, and it's not going to get better if there is no action, decisive action on against global warming, and this implies a number of things for society. Now, of course, we are not suggesting here that central banks have the silver bullet to deal with climate change. On the contrary, central banks are only part of a much broader effort that should involve all actors in society and all actors across the world. It's a global problem, and central banks can at best relate climate change to financial stability, and to some extent advocate that there needs to be awareness, there needs to be a better look at these risks in the balance sheets of the financial systems, that they can coordinate a little bit the action of other actors, of regulators. They can sort of work with governments to precisely take the necessary actions to mitigate the risks that are emerging. So they are not a silver bullet, but they should consider this as a problem that affects one of their objectives. So I stop here. I thank you very much. Muchas gracias por la atención de todos y termino aquí.
Okay. Okay, well, thank you. It was very clear. It's very interesting. I'm going to make you a first question. The question is, in your article, Inequality, Hysteresis, and the Effectiveness of Macroeconomic Stabilization Policies, you point out that in the last 2 decades, both tax progressivity and unemployment benefits have been reduced, and that this has weakened the automatic stabilizers of fiscal policy. In turn, increasing public debt, which leaves less room for monetary policy, and this has been clearly seen in the pandemic. After the exit from the pandemic and the war in Ukraine, the global context is inflationary. The worst major central banks are now discussing how much and how fast they should raise interest rates, not for the very purpose of lowering inflation, but to defend their own reputations. In this context, what are the most advisable monetary policies for the central banks of emerging countries, taking into account the inequality, but at the same time, the need for macroeconomic stabilization of their economies?
Gracias, Agustín, por la pregunta. Look, I think, as I said at the beginning, we are in a very serious risks of having high inflation for a long period of time. And therefore, all central banks in the world, and I think in Latin America, they've been very active preventively, should address the inflation issue with the determination that they've been using so far to combat inflation. One reason being that if you allow, and we know this very well in Latin America, inflation expectations to become de-anchored, then you see a number of adverse impacts on macroeconomic and financial stability. So therefore, the role of central banks in the current circumstances for me is to definitely be tough and address their inflationary issue with the utmost and more forceful determination. Now, it doesn't mean that you don't have other instruments to address some of the issues that you mentioned, which are the issues of redistribution and inequality. But I would say that the sound division of labor between fiscal instruments and the role of the monetary authority could be envisaged. You know that inflation is the most unjust, the most unfair tax on the poor. So this definitely has to be addressed. On the other hand, the other instruments that we have, and some of them are being used in developing economies, is the way in which you can design specific targeted transfers that would address these issues that you are alluding to, and which are also very serious. The issues of rising poverty, the issues of entrenched inequality. Of course, this has to be done within a context where you should work together with all other agents in the economy for macroeconomic stability. But the good news is that we have now better instruments to identify some of the areas that require targeted transfers. I talked about digital transformation. Think of it in terms of what some countries like India are doing in terms of using a digital identity, knowing better the risks to individual credits. Think of the way in which China has developed with big data, artificial intelligence, a identification of individual credit risks that actually allows, even if you are in a tightening phase of a cycle, to actually lower the relative hikes that are necessary to keep inflation in check, while at the same time allowing some specific businesses that otherwise would not have access to credit at all to still benefit from credit because the risk that they represent is better priced, better identified. So this would be my way to sort of try to address the very important issue that you mentioned.
Thank you. Horacio?
Thank you, Luis, for the very timely and relevant presentation. Indeed, it comes at a time which is very challenging for macroeconomic policy, and when other international organizations seem to point in similar directions to the framework you just presented. For instance, the IMF integrated policy framework and its recent review on the institutional view on capital flows. Even G20 finance ministers and central bank governors in their latest meeting have welcomed these advances and have called for, and I quote, the coherent implementation of international frameworks for the use of capital flow management measures. Now, my question is, how does the macro financial stability framework of the BIS relate to other frameworks? What are the features they have in common and the differences? How does it relate to them?
Thank you, Horacio. It's not a BIS framework for the moment. It's research, right? So it's being discussed and it's being revised. So what I can say is that we discussed extensively with Tobias Adrian at the IMF, and I think they made a great effort in developing their own integrated policy framework. What we are suggesting is that there is a need indeed for dialogue between institutions, between central banks. We are proposing an example of, let's say, the way in which pedagogically you can see how combinations of instruments, for example, monetary policy and macroprudential rules, okay, work together to achieve price and financial stability. And then you add another instrument. You say, how does monetary policy and FX intervention work together? And so on and so forth. So we are proposing a bit of a pedagogical approach that can serve as a dialogue together with other international financial institutions to precisely get the discussion not only in terms of feelings, but a bit more into their analytical underpinnings. Now, this is the task of IFIs, but this is also something that a good dialogue with the practice of central banks makes it even more interesting, because it resonates with what central banks have been doing. So we have been also talking to colleagues in many countries, and the feeling is that indeed it is useful to have this dialogue. Now, my last word is that we are observing a bit more of coordination in terms of signaling of monetary policy directions in advanced economies. Because one of the observations of this period of greater instability brought by the global financial crisis is that you have spillovers from advanced economies into emerging markets, but you can also have spillbacks of destabilized emerging markets into advanced economies. So if you look at the recent communication of some advanced economies central banks, they mention explicitly the fact that they pay attention in the way, of course, their mandate is domestic inflation, but they are not unaware of the spillover effects that this can bring to EMEs. So best thing is to get, let's say, your house in order, and also to conduct a coordinated dialogue with between central banks of both advanced and emerging economies. And this is, for example, one of the tasks that we do here at the BIS.
Thank you.
Okay, well, I have the last question about this presentation. First, I would like to highlight the practical aspects of your presentation, because they are not only a list of common practices in emerging Latin American countries, but fundamentally useful in times of great financial instability. And they have been so in the different periods characterized in your presentation, from the 1980s to the present, where the reserve buffers of most central banks have been created. However, I would like to draw attention to the sample of Asian countries brought to us today. We see that most of them declare to have actually carried out interventions in the foreign exchange market, BIS, ACC working group. Nevertheless, only one of these countries captures that intervention. I understand Indonesia. To what do you attribute this? Could we say that these are marginal or sporadic practices in that region at present? And do you think that in this new context of instability, exchange rate interventions can be disregarded from the modeling?
Very good question, Agustin. Look, in the modeling, I remember I put a trade-off between the complexity of models and the type of effect that you want to capture. So FX interventions in the simple models that the simplest models that you can bring is basically a smoothing of the exchange rate, right? It plays a role of smoothing, and therefore it has an effect on asset valuation, on foreign debt held by domestic banks and also households, and therefore it allows to avoid abrupt adjustments in balance sheets of these agents. Now, in reality, if you go to the practice, and you're right, there are many, many ways to conduct FX interventions, and it's difficult in a modeling exercise to capture all these ways in which you do it. You can intervene in the spot, you can intervene in the futures market, you can intervene with derivatives. So in many cases, as you know, and for example, the case of Brazil is one of them, but also in Mexico, also in Indonesia, interventions were often conducted in the futures market through NDFs, so non-deliverable forwards. So this is not something that affects for example, the level of your reserves on the spot. They have essentially the capacity to leverage some of the foreign assets that you hold in order to sort of remove the excessive pressure that futures markets are exercising on your spot market. So you in a sense, it's a signaling effect that doesn't provide any clue that the authority is aiming at any specific direction for the exchange rate. You should keep in mind that a floating exchange rate is the first line of defense. It allows you, it's a buffer that allows the fluctuation of the value of the currency to absorb some of the shocks, either in terms of appreciation or depreciation. But what we're talking about here is when these movements become self-fulfilling prophecies and become excessive, and the role of the intervention is to remove the excessive ways in which these movements will affect price and financial stability, not to set a certain level, not to set a direction, but just to remove the excessive volatility and to avoid affecting the financial stability of the balance sheets of firms, households, and your banking sector.
Okay, very clear. Thank you so much for the presentation and all the answers. Thank you.
Thank you, Luis.
Okay, muchas gracias, Agustín, Horacio. Y thank you again for inviting me for the conference. Thank you.
A pleasure. Thank you for you.